be very careful with your due diligence costs. A lot of deals seem really good. And so, as GP, we're kind of quick to put in the down payment and pay for the appraisals and the environmental studies and that sort of thing when we're doing developments, but you don't get that money back, you know? So you gotta, just be, take the time. Due diligence is annoying and it sucks, but you got to do it because we've lost our due diligence costs in the past, and that's painful.
Hi, Adam Gower here, founder of gowercrowd.com and host of The Allocator, a brand new way to finance real estate podcast and YouTube show. Welcome to today's episode. My guest today is Austin Hare, who is, and he did tell me, I think managing partner or something. Sorry, I've actually forgotten momentarily, but he is one of the key people at Leaders Real Estate. Austin has a very interesting background. I actually thought before I recorded today's episode that he was an active capital allocator, but he's not. He's been raising money. He's involved in the medical real estate industry, which I think is a fascinating asset class. He's raised money for his own on his own account for his own deals. He's been quite successful. He's got some very interesting anecdotal stories, and he talks about his background very nicely. It's interesting to see how he came into real estate. He's open and upfront about some of the challenges that he's had throughout his career, and he is looking at becoming a capital allocator. So he talks about all the options and the world that he sees as he contemplates doing that. So it's an interesting perspective. Not only that, he's a super nice guy. Right? So you're going to find out in a minute all about that. If you have not yet done so, please subscribe to my newsletter. It's there at gowercrowd.com. Just click the subscribe button. You'll actually see a list of the companies that some of my subscribers work for. Gowercrowd.com/subscribe, or just hit the subscribe button. It comes out weekly. And I am concentrating on providing guidance and insights based on my extensive experience in commercial real estate, primarily because I'm going to be investing myself this year, but also to provide you with some capital raising tips and some AI stuff and cover the podcast, all kinds of cool stuff. So anyway, all there, gowercrowd.com/subscribe, or just hit the subscribe button on the main menu. All right, enough of that. Here he is, Austin Hare, Leaders Real Estate. Austin, good to see you. Thanks so much for joining me. I do think we met on LinkedIn. I might be wrong, but I've been meeting a lot of people on LinkedIn, so it's distinctly possible. Anyways, this series is about capital allocators and that whole industry. And I know it's something that you do, but I know it's not where you started. So why don't you tell me a little about your background, your story, and how you got into the capital allocation business?
Yeah, so we did meet on LinkedIn, by the way. Pretty sure about that too.
All right, good, thanks.
Yeah, but I got started 14 years ago in 2011, which is crazy to say because I feel like I'm just getting started. But what happened was I was a professional wakeboarder and I was renting out houses where I would essentially sign the lease to the whole house and I would take on the risk, and then I would rent out each room individually month to month with the goal of offsetting my rent so I'd get free rent. So I did that in conjunction with wakeboarding to like essentially save up enough for a down payment. And I had just read the book Rich Dad Poor Dad, or which I'm sure you've read it too, right?
Of course, yes.
Yeah.
It's a standard, well-thumbed volume.
Yeah. It's like I feel like it's like book one for everybody to read. There's good bits and bad bits looking back on it, but it really changed the trajectory of my life. And so, it got me thinking about real estate investing. And essentially I remember the moment in time actually was we were on the back of the boat and my roommate had just got done wakeboarding, and it was like probably like December 2010. And the market just felt terrible. Like between 2008 and 2011, I mean, like it was just a falling knife. Like if you remember, there's blood on the streets, everybody was scared. I mean, but my roommate said, "Man, I wish I had enough money to buy a house. I go buy a house right now." And I thought about it. I'm like, huh, like that's like first of all, it's an interesting thought. Like they are really discounted. Second of all, like it kind of feels like a victim mentality to me. Like, oh, I wish I had the money. It's like I don't want to ever be a victim. So like instead of saying I wish I had the money, like how can I do this? And so essentially, I went looking for a house that I could afford with the down payment that I had saved up and my debt to income ratio at the time. And I ended up finding a 4 bedroom, 2-story house on the lake with a pool and a hot tub and a guest house for 185,000 in Orlando.
Right.
And it was April 2011, so the very bottom of the market, And so I just got super lucky that I was kind of like at the age, at the point in time where I just graduated college and was looking, I mean, sorry, graduated high school. I was in college at the time. Looking for to buy a house and yeah, the stars just aligned. Now it was a piece of junk and it took a lot of money to fix it, but while like the difference between all of my monthly expenses, mortgages and utilities and whatever, like I was making like 1,200 bucks a month to live there, and then inflation adjusted would be even more today. But I had the master bedroom with the view of the lake and all that kind of stuff, and so I was kind of stubborn. I was kind of slow. I continued. I didn't really realize how good real estate was. I continued focusing on wakeboarding. I was in school. When I finished school, I continued to juggle wakeboarding and opening up some fitness centers. And it was actually more through the fitness centers that got me really into real estate because I was growing by what you'd call de novo, which is just like starting new locations instead of acquisitions. So I had about 3 of those, and I was looking to do my fourth one, and that's when I met my partner, and he did a location, site selection competition analysis. And what we found was that my gut feeling about like, oh, in Orlando, Winter Park is like the cool, sexy area that you got to be at. It was actually way really far off, and
Mm.
Kissimmee had really good demographics. So I was like, huh, that's interesting. Like the data, you can't make good decisions without good data, is what I found out. And so I was getting a little bit burnt out on healthcare. I mean, not healthcare, sorry, on gyms, health and fitness. And like I'm sure your story goes all over the place. So like there's like a lot of overlap between buying the first house, continuing to wakeboarding, graduating from school, opening the businesses, buying a second residential rental property, putting that on Airbnb. All this is kind of going along on like these different timelines. But I ended up selling the gyms because I was burnt out and I got in a disagreement with the franchisor in November of 2019. So right before COVID.
Okay.
Luckily, I had signed up for Gym Launch. Do you know Alex Hormozy?
I do know that name, yeah.
Yeah, so Alex Hormozy is pretty well, he's up there with like Gary Vee and those guys now. But at the time, he was just getting started. This was 2017. And so, we got to meet him and go to the conferences, and he showed us exactly what to do. I mean, it was awesome. And we were like printing money. And so,
To
luckily, we
do
were one of the few
what? Exactly to do what? So,
how to grow your gym.
oh, a gym. Oh,
Yeah,
okay.
yeah, yeah. So
Right.
so now Alex is broad business. I mean, across the whole spectrum. Business coaching and acquisitions and teaching people how to scale and
Right.
that sort of thing. I mean, he's a 35-year-old guy worth well over 30 or 36, I guess, but worth he crossed the $100 million net worth mark when he was like 32.
All right. But
Um,
you're going to get to how you got into allocating on real estate
Yeah,
allocating.
sorry, I'm
Yeah.
long-winded. So long story short, I'll summarize it. When I sold my gyms, because my partner showed me how to do the site selection component, we decided to focus on doing that for healthcare groups as a way to cast a net to get the first dibs on when locations became available. So that was essentially like, okay, we'll do your site selection, and then with healthcare, a lot of groups don't like to buy the real estate. So that was the kind of the rub is like, when you find a great deal, the landlord wants to sell, they don't want to buy. Sometimes the deal would fall through. So we said, hey, let's just buy the real estate. So there's been a two-prong approach. One of them is I continue to do short-term rental or residential real estate that I turn to short-term rentals and wedding venues. I've done that a handful of times and continuing to work on that. And then the other part is doing healthcare-backed real estate. And so that's a long-winded explanation. Happy to, kind of dive into any one of those.
Okay. So tell me about how you raise capital because that's what I'm interested in, the capital allocator aspect of it. And so
Yeah,
how
so
do you raise your equity? All right.
yeah, raising equity is
But do you raise equity for other people or just yourself? I thought you raised for other sponsors. I thought that was part of your business model.
yeah, so right, so historically it's only been for our own deals. And so what I'm experimenting with right now is yeah, like scaling this out to do the same model for other ventures as well and trying to figure out a model that is essentially fair across the board, which is what, you and I were talking about. So yeah, our model for raising capital is there's a couple different approaches. We have a podcast as well, which
Mhm.
you've been on. And so part of that is building the relationship with the guests when they come on. And we call it content-based networking, but that's a big source of where we get our investors from. And then there's also just the personal relationship part of it with both friends, families, with the four Fs: friends, families, followers, and fools.
I
Is what
see.
they call it. And so it's posting content online, but then engaging with the podcast guests, virtually, but also the 1-2 punch whenever you can meet up with them at events. So we try and go to these events and endemic events to reinforce the personal relationship.
Mm. And then, but you raise, you're looking at raising capital for other sponsors, are you? Why is that? Why are you not trying to just grow your own portfolio? What's
Yeah,
attractive
so I just
about
was
that? Mm.
kind of like, I guess, the epiphany moment I had. So, we spend, like, for everybody in the capital raising, whatever, everybody in real estate, I'm sure, knows you're wearing multiple hats, right? And specifically, like, it's almost like, okay, let's go find a deal, like, all hands on deck, go, 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 go. Okay, great, we got a deal. Okay, let's go capital raise, all hands on deck, go, 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 go. Okay, that's done. No, let's go find a deal. And it's like back and forth, back and forth, back and forth. And so, we spent a lot of time, like, originating deals, and that took a lot of effort. And then whenever we got a deal, go and raise capital, right? So it's like this thing. And so my thought was, hey, just because you can find a deal doesn't mean you can raise capital. But if you can raise the capital, then you can definitely find a deal. And so the biggest bottleneck that I'm seeing across the board with a lot of real estate GP, general partners, syndicators, that sort of thing, is the capital. So you spend a lot of time finding these deals, and these are great deals. I mean, there's so many groups and masterminds that I'm involved in where there's phenomenal allocators, like they're really great operators, and they're finding these awesome deals, and then they're just having to spend a lot of their time and bandwidth raising capital, right? And so it's like stop and go, stop and go, stop and go. And so essentially, the way I look at it is if you kind of have like three kind of parts of a deal or a fund, like you could call the fund manager, the fund operator, or I guess the expert investor, which is like the deal finder, and then the fundraiser, right? And so those are kind of the three hats. And I think focusing, 100% on the fundraiser allows more scalability. So does that
Well,
answer your
hang on a
question?
minute. So just a sec. So I need to unwrap that. I didn't quite understand what you were saying. First of all, which masterminds are you a member of that you like?
So there's a group called Fundraise Capital with Ryan Miller. He's got a podcast called Making Billions. I don't know if you're familiar with that. It's gained some
Okay.
traction. You are?
No.
Oh, okay. Yeah, yeah. It's gained some traction in private equity, but it's there's a lot of private equity funds that are involved in his group. The other one is called Black Card, founded by a guy named Bridger Pennington. About it's called Fund Launch. Well, Fund Launch, and then specifically Black Card is like the top tier level of that.
Okay. Okay. So you said there were three, you were describing it as being three tiers. So there's, just
Yeah,
explain that again because
yeah,
I
yeah.
quite follow.
I know. I should have brought like a whiteboard or something.
That's
But
all
this is
right.
actually not my I wish I could take credit for it, but I'm just it's just how Bridger Pennington explains the model in Black Card. So when it comes
Okay.
to launching a fund, he explains it as kind of like you have three roles, and it doesn't mean that it's three people, could be, but the three roles are the fund manager, then you have the expert investor, and then you have the capital raiser. So
So what's the difference between the fund manager and the capital raiser? And
so
let's just put that into the real estate realm.
yeah, so in terms of those roles, imagine let's use a simple example, like a fund for fixing and flipping houses that I think people can wrap their minds around.
Okay.
Um, when it comes to that, like you're not going to be just doing one house, obviously, right? Like if you raise a couple $1 million, that can give you a lot of, gasoline to do whatever, 10, 20 houses, I don't know. So there's going to be a person who has to like originate your fund docs, right? And then they're going to be like it's everything like when it comes to capital raising, that's like, hey, I know, originating an investor, finding a lead, which would be an investor. That would be meeting them, taking them out to dinner, scheduling Zoom meetings, the whole entire funnel process, all the way, in my opinion, to sign documents. Now, people have like different definitions of this. Some people just think a warm introduction, right? I think like the capital raiser's job should be all the way to sign documents, and then I think it should actually
Well,
even be
how else is it not all the
right.
way signed off?
I agree. I've heard people say that like they just do the introduction, right? Like so I'm out finding capital investors, and then I would in certain scenarios you would introduce them to the quote unquote fund manager. That could be some people call
So
that a
what's the
capital raiser.
fund manager?
So the
And then
fund
how
man
do you get
so
compensated if all you're doing is making an intro?
Yeah, so that would be the capital in that definition. Some people define the capital raiser as a person who can introduce them to investors, to the fund manager, right? Like I'm just giving that for reference. I don't think that's the case. I think the capital raiser should be signed documents, but that also implies that the capital raiser is going to be creating helping with the pitch deck. So you're gonna be helping with the pitch deck and the data room because these are all things that are investor facing. And then I think it also entails with investor relations on the back end. So after they have their money, you as the capital raiser are still going to be sending out quarterly updates. Now, the fund manager, however, they're going to be the ones running all the books. They're going to be the ones, like in the third category of expert investor, they're going to be looking for the deals, right? They're going to be making offers, signing LOIs, doing all these things. But then the fund manager would essentially sit at the top and make sure, like, yes, we can sustain this deal. Like, we're going to be, they're going to be signing on the debt or at least getting the banks, like, maybe competing the banks against each other, bringing
Okay,
in all the
so these are
GP.
this is the professional real estate operator, somebody
Yeah, an
who
operator,
is
right? Yeah,
running the
running
project,
everything.
actually from finding deals and then closing on them, signing on debt,
You can.
and putting the deals together. And then you
So
have then you have a capital raiser. So how are capital raisers and how are you contemplate? Now, have you done this?
we have no, we have our own internal splits between me and my partner, but
Okay.
in terms of looking to do it with third parties, I can tell
Yes.
you the way that I think it should be, and I can tell you the way that Bridger has recommended it from the black card, which is
Okay.
essentially each gets a third, which is what I agree with
A third of what?
of the general partnership.
Oh, I see.
Yeah.
Okay.
Yep. So there's a little bit of a difference between a syndication, which is just a one-off deal, and a fund. So like with a syndication, you don't need the role of fund manager. You pretty much have your quote unquote expert investor or your operator, and then your fundraiser, right? Like those are kind of the two roles. But with a fund, it's a little bit more layers of complexity because you're doing like a lot more deals, and then you're a little bit less hands-on, probably in the construction and in the case of a fix and flip or whatever the asset is, right? Um, and you're operating more at scale. So higher dollar amounts, your margins might be slightly lower than if you're just doing a syndication, but you're able to put a lot more capital to use, right? Like,
Yeah.
so what if you can
Right.
get, right, if,
So capital allocators typically raise capital for multiple sponsors in the real estate space. How does that work though? How does that model work in those circumstances? What are you thinking of doing?
so yeah, I'm thinking of just getting involved with a fund because funds also have like start and stops, but they're a little bit longer periods of time than syndications. But just an equal third of the general partnership for the fundraising responsibility, right? So let's use easy numbers. You have and I think by the way that the fairest way to do it is also pro rata, meaning you don't have to necessarily have one person raise the entire capital, right? Like if somebody has to come in alongside them and help them, in my opinion, they should also get a share of that. So if you've got a third of the GP allocated for the fundraiser, right? And two people, maybe a person, maybe the fund manager, or maybe it's another person, they come in and they help raise that. I think that GP should be split pro rata amongst what you raise. So in the case of $1 million raise, to use easy numbers, if you only raise 500 grand, you should only get 16% of the GP. And you can do that with clawbacks. I've also seen, I actually was just talking with the group. They do that. They have their documents, subject to tweaking, right? Like their PPMs
So
state that.
compensation is based in this scenario on how much you raise.
Exactly.
Yeah. So tell me more about the real estate animals because I think of allocators as I think of the world slightly differently, and these terms are becoming quite convoluted. This term fund and fund manager. I come from an institutional world where these terms mean something very, very
Well, I'm
different.
curious. Yeah, so then maybe you can help me understand what do they mean to you?
Well, hang on a sec. So let's just drill down on the real estate idea.
Okay.
So my understanding of what an allocator is somebody who says, okay, I'm going to negotiate preferential terms with a real estate spot professional, right? A real estate sponsor, and they've got a deal and they're offering 8% and a whatever 70-30 split. I'm going to negotiate a 10% and an 80-20 split provided I can raise a certain amount of money, and then they they either keep the delta for their compensation or they split it with investors that they bring in, but they set up another entity. It could be a fund, right? And they have multiple sponsors in those. What you're describing is something different, isn't it, Austin?
Mhm.
So what direction are you thinking of doing? If the way you describe it sounds like you want to work with just one sponsor to do this. Is that right? That's what you
Yeah,
want?
so that's correct. I think largely actually in dealing with you, and like doing your course and all that kind of all the kind of stuff, like hopping on your course, which is great by the way for everybody listening.
Thank you.
I learned a lot from that. But one of the things you pointed out was the branding, right? And so like having consistency across your LinkedIn and your social media and your landing page. And so what that led me down the path of is like, finding a good partner, at least for a period of time, but finding a good group that I trust as a good track record, because the last thing I ever want to do is lose an LP's money,
Mm.
an investor's money. And so along that line of thinking was like, yeah, why don't we spend a lot of time looking for deals, right? Like that's our bottleneck. Like we've been able to raise the capital whenever we have a deal because our deals are pretty good. I mean, like healthcare real estate is in high demand. But my thought was, okay, how can I scale this more? Well, why don't I partner with people who are doing what I'm doing already, which is finding deals, and then I can focus on the capital raising side of it. And so instead of being split focused, I can have more of a singular focus, and then let these general partners, these operators, find the really good deals and operate them, and then I can work on bringing the capital. But it allows me to wear one hat, and then my branding and um, my social media presence and the messaging and all that kind of stuff can be consistent, right? And maybe it's for a time. Maybe I work with the group for a year while they're
So
fun.
how
Because
does that work though? So let's say now you find a medical office, let's call it an MOB shop, right? Medical office building shop that has been doing this for decades and they need more capital. So you're going, what's your conversation with them?
it's actually would be with another real estate group. So our real estate has always been finding real estate deals for healthcare backed real estate, meaning like let's just take a dental group. When they're growing, and a lot of them are private equity backed, they don't want to put their capital towards real estate because they want to save it for operations, right? So that's where a group like us could come in and we could buy the real estate, we lease it to them, they got great credit, right? The issue that we were facing was that a lot of these groups, because the returns are better, are wanting to buy their own real estate. So our deal flow was getting harder to originate. Like it was harder to originate deals.
Mhm.
So the pivot is essentially working with other groups who are all like, it could be any real estate asset class, but where the returns are strong and the asset is safe, and then partnering with that group in as a capital raiser for that
When you say
specific deal
group,
or
you're
fund.
talking again, just to clarify these
Yeah,
terms, because I'm just losing it.
general partner.
All right, a general partner. So this is somebody who's been in business, has done value add multifamily or medical office or
Exactly.
bought data centers or self-storage or whatever it is. They've been doing that for years. And they want to continue doing that, but they need capital. So what is your conversation with them? You can't walk in. I mean, or is it? Your conversation is we'll raise the capital provided you give me 30% of the GP. Is that the conversation?
In short, yeah, yep. So I've been kind of, active in these groups, kind of posting, seeing what is the need, what's out there, what's available. It does range. Like there are different funds, and different funds have like different like levels. So like you might have like your Series A, and then you're gonna have different levels. So that's a little bit more complicated. But in terms of like just to your example, a multifamily deal, maybe they have a fund and they're doing a multifamily. It's a $15 million acquisition cost and you need 5 million of equity, then yeah, there are groups absolutely who are already you do willing to pay 30%, 33% of the general partnership for somebody who's going to come and raise capital. So it's already there are groups out because they get like we were talking about a second ago, they get going, they get steamrolling, they get good at originating these deals. Now all of a sudden they got a handful of deals and they need a lot more capital, right, than they did when they were just doing one at a time.
You mentioned platforms where you're meeting. Like, how are you finding folk like this?
So yeah, I don't know how much you want me to get into detail about this, but I'm happy to share it. Black Card is a branch of Fund Launch that was an expensive program. It was like $30,000 for the first year, and then 10 grand a year after that. But part of the deal was like they do all your legal documents for your fund the first year. So that's part of it. Fundraise Capital is another group. There's a guy, again, his name's Ryan Miller, and that one costs about $10,000 for the year, but again, great value. And so there's Slack channels, there's
And
WhatsApp.
then what do they, so what's behind the curtain there? This is people that want to raise capital as well. And so this is a place for capital raisers and capital raise, well, hang on, sponsors who need capital and then capital raisers, investor relations people to meet, is it?
Well, I think that most people in these particular groups are joining because they need to figure out how to raise capital. So they're kind of doing something that they're
Uh,
like, oh, this is working, this is a good idea. I need to go and raise capital. So usually it's real estate, but there's a lot. I mean, there's plenty of hedge funds, startup hedge funds, crypto funds,
oh, I
even
see.
like
So hang on a
roll-ups.
sec. So most of the people in there are professional real estate professionals, people
Yeah,
who have been doing value add multifamily for years or whatever it happens to be. And so by showing up there, you're able to look at all these folk and say, listen, I'm interested in helping you raise capital.
correct.
So how do you evaluate them?
Well, I think it's a little bit of a long process, but it's just like a deep dive, I guess, like in the due diligence. So, what I look for is a strong track record. How long you've been doing this for. I look
So
at,
what describe what that looks like to me? Somebody that you would be interested in working
yeah,
with.
if
Your
somebody's,
primary screen.
if they've been doing this that for I'd want to see. It depends on the size of the deal, but like the more deals, the better. But I would say like at least five, if at least five deals, and then over the course of at least 5 years, if not 10. Again, 10, 15 years, that's better. And then in addition to that, it's what's the IRR been historically for your investors, and then what's your turnaround time. So one of the trade-offs too, this is something that I've been thinking
Turnaround
about.
time. Turnaround time.
Well, just like are you a buy and hold or do you flip? Because there's trade-offs for both. As we've been talking about that a lot on
Hmm.
LinkedIn. Like there's a sweet spot where you can time the value add, like to flip out of the deal, to as a developer or whatever it is that you're doing in real estate. But then you got to pay taxes. You're going to pay capital gains taxes, and it's really hard to originate a 1031. However, you do get the most amount of money, and if you know what I'm saying, up front. But as a GP, like so, for somebody who's raising capital for the GP, means you're getting carried interest. And so the longer that you hold the deal, the longer it's going to take to make money as a general partner.
And how else? So if that, and that's the scenario that you're looking at, right? You want a share of the GP economics. You want to split those. So how else are you getting compensated in any circumstance, right? So if you've got even a 3 year or a 5 year, and presumably you're not interested in long term because then you don't see the bulk of your compensation for a very long time. So uh, how else do you get
Well, it would
compensated?
just be, yeah, one of the things that is up for negotiation for some people is a management fee. So if there's a management fee, that would be a way to start getting, compensated immediately. I do know of people who raise capital for a fixed salary, minimum guarantee. Maybe it's like $10,000 a month or 15,000 or 5,000. There are definitely people who do that. I've just wanted to create a shared alignment, by the eat what you kill model. I don't know, has just always resonated with me. Maybe at some point in time, I'll explore that. And I get why people do that. Because yeah, if like you're getting part of the carried interest and you've got a 10-year hold, well, oftentimes during a real estate acquisition, there's almost nothing those first couple of years because you're putting in money in some form to create value, right? And so it just takes a really long time to physically get paid. And so you got to be like independently wealthy from something or have a side hustle or another business or whatever it is. Ironically for me, like my short-term rental business and the wedding venue business has been my cash flow business. So that's been putting all the cash in my pocket and that's been great. But there's not a lot of equity there. If you ever go to sell a short-term rental, it's largely based on the comps, right? And then the healthcare real estate that we've been doing is largely equity based. So we're building long-term wealth. So I've been lucky in that I can balance those two. And maybe some people aren't in that position where they can just afford to wait 10 years.
Ah, I see.
Um, but yeah, that's kind of been my
So you're
my
primarily looking for just a share of the GP economics.
yeah, and like you know, I'm not partial. They don't have to be long-term holders by any means, right? Like they're just all I was trying to say is that there's pros and cons to both. So I'm 100% willing to work with developers who flip, right? I'm 100% open to the idea of flipping. I'm not saying don't do that. I'm just saying there's tax repercussions.
Okay, so you just used the plural, developers, not developer. So you're looking to work with one or multiple
Uh,
sponsors? Yeah.
yeah, so this is actually a good question because it was in talking to you and doing your course that I think
Hmm.
I even brought it up maybe on the call. I don't remember, but it's like that consistency, you know? And maybe I can just ask you right now while we're recording is what do you recommend? Because I don't want to be, I don't want to be a jack of all trades, right? It's like I do see how you can be a capital raiser, and that could be the hat that you wear, but I'm having a hard time envisioning how you do that across like multiple different like my thought's kind of like one at a time, like work with the group, see how it goes, and then when that raise is done, because it kind of starts and stops, then go work with a different group. Like that was kind of the way I foresaw
And
it.
do
But
they have to have funds, so to speak, or just individual deals
no,
worth?
yeah, it could be a syndication.
Okay, so it could be a like series of syndications. Yeah,
Correct.
it's a challenge, I think, Austin. What have you seen actually? What kinds of opportunities have
I've
you?
seen a lot in the multifamily. I was always so reluctant to get into multifamily. I didn't want to touch it with a 10-foot pole. Like when I heard about these cap rates, I just couldn't make sense of it. This is back in 2020. But since then, it seems like it went out like this, and then it dropped, and now it's kind of stabilizing back at normal returns. Is that kind of what you're seeing?
Yes, somewhat. I mean, there's a lot more going on in
Yeah.
the economy, and certainly will be
Yeah, so
later this year. Mm.
returns are in the handful of people that I've talked to who are open to joint venturing on something like this, returns are stabilizing in like the 15 to, I don't know, 18% IRR. Now that's what they project. They think they'll be a little bit higher. But I mean, it's not the 30% you were getting, but they're not doing these equity in refinances that we saw like last year, right? Where it's like they were just so upside down on them. So that's the deals that I've seen.
And so, how do you expect to, or so the value prop that you bring to investors is just the good deals, right? So you're going to evaluate a sponsor. You're going to do it one at a time, at least to start with. Evaluate a sponsor. They got to have 5 deals and 5 years of experience minimum, and then cut a deal with them. And then how do you? What's your process then for
Well, I've been we talked about at the
raising
beginning.
capital?
So I've been investing in real estate since 2011, and essentially, I've gotten my teeth kicked in a couple times on these deals. They haven't all. A lot of them have gone great. Not all of them have.
Mm.
And so essentially, what I talk about, like when I'm a guest on a podcast, in terms of like getting investors and stuff like that, is just understanding the trade-off. So a lot of people want to invest in real estate, but they think largely because of Rich Dad Poor Dad, that it's totally passive, which you and I both know it's not. And so the value add of like, why would you work with Austin? Well, it's just because if you're going to be a real estate investor, then you just have to understand you're going to have to spend, there is no, it's a spectrum of passive versus active income. And so on the most passive side, you've got like just being a limited partner in a deal where you let an investor do that. On the most active side, you're buying like a wedding venue or a short-term rental or even like a residential property. Who's calling the plumber to fix the toilets, right? Like who's finding the tenants when their 12-month lease is up? You know what I'm saying? Who's vetting them to make sure that they're a good tenant? Like it's not passive. And so you just have to understand that you're going to be spending your time in that. So the question is, do you want to spend your time in that? Do you want to be an expert in that? Do you want to look for like off-market commercial
Mm.
real estate deals? Like that's great, but there's going to be a learning curve versus like, what is your occupation? Are you a business owner? Are you a dentist? Are you a doctor? Are you making a lot of money
Right. So
now?
that's selling the concept. How
Yeah.
do you expect, or how do you anticipate, should be the word. How do you anticipate raising capital for a specific sponsor?
Well, then, yeah, that comes down to just so like, there's plenty of groups that I'm looking at that I'm not interested in investing in. I mean, sorry, raising money for or partnering with. because of there's too many yellow flags. I'm not going to say red flags, but too many yellow flags.
Hmm. Like
So
what kinds of things do you see that you don't like?
just like really high IRRs. Like if somebody's IRRs, okay, so there's a couple like if we go outside of real estate and we just talk about capital raising, I mean I've just seen crazy like 70%, 80%, 90% IRRs, 100% IRRs, like that sort of stuff. And I don't know. To me, it seems too good to be true, right? And I'm sure you've dealt with that kind of stuff too. Um, and and then sometimes like the even like the in real estate, maybe the IRRs are okay, but like it's too ambitious. Like somebody starting a first time fund trying to raise $100 million or even like $10 million, you know what I mean? With inexperience. So it's just like, and maybe that's just my personal preference of the way that I do things. Like we've always been really focused on the risk adjusted returns. So like the reason we chose healthcare was because according to the SBA, dental and a lot of other healthcare groups have like the lowest default rate. So, I think about it in terms of like preservation of capital, return on of capital before return of capital. So, obviously I have my own biased lens, we all do, but it's just the experience that I've had starting real estate 14 years ago is essentially vetting the deals for, um, high income earners who want to generate passive income, by investing in real estate. You just might not have time to do this level of due diligence yourself.
And then what about how do you sorry, I lost my thought. Hold on a sec. Oh yeah, so you've not raised money for sponsors yet. But
Right.
if you were to find somebody, how much do you suppose in the right circumstance you could raise if they had a deal, you know, next month?
Yeah, you're saying like within 30 days, or you're saying like if I met them next month and they had a raise
Yeah,
going on for a period
you
of
find a
time.
sponsor today and you think they're great, you sign up and they say we'll give you, 30%, whatever, a third of the GP on this
Yeah,
deal.
between
What could they expect you to
my
raise realistically?
yeah, so my goal would be between 500 and a million. I'm looking at groups that are doing the 14 million, $15 million acquisition size is a deal that I've looked at that I've considered partnering with. So, in that situation, it's $5 million. There would be maybe it's part of the GP that's already existing that's also going to be raising, but they need help raising the capital, so I could come in alongside them and help them.
Hmm. So how would that work then if you raised 500,000 and their total raise was 5 million, for
It would
example?
be 10% of the GP allocation of the capital raiser allocation. So if the GP allocation for capital raising is 33 and I raise, you know, a tenth of that, then I would just get 3.3%.
How do you stay compliant with SEC regulations, securities
If
regulations?
if you're part of the GP, it's actually compliant. So that's how you get it. Yeah, because otherwise you do have to have your Series 65.
Right. But also compensation based on the amount that you raise. Have you looked into that?
Well, yeah, that is a topic that's come up. Yeah, I don't know. Yeah, that's a
You
good
should
question.
know. So that's something you want to talk to somebody about, right? I'm not a lawyer, but I do recommend you take a close look at that. Sponsors, Austin, who understand this world will be able to guide you as well because they don't want to run afoul of securities regulations
Right.
at all. Are there any? I tell you what, let's have a quick look. See, we've been going such a long time. I see it's a really interesting conversation. But I tell you what, I've got like a million other things to ask you. But as you are just starting out on the allocator side, let's revisit again once you've actually started to put some deals together for a sponsor, and let's look back at how you did that and what you put together. What I would say is a couple things. One, I do have a capital raising mastermind that I'm going to be running in February. I'm not sure if I've mentioned that to you. Similar to the LinkedIn training
Hmm.
style, but entirely focused on best practices for capital raising. I will probably haul in an attorney to answer legal questions as well during that. You really do need to cover that, Austin, to be compliant. So I'll tell you more about that later. But to, as much as I would like to go on for a lot longer, let's wrap up because we're at 40 minutes already, and I was hoping to get
We
to
went
30.
over.
Let me give you five rapid fire sign off questions that I've got, all right?
Great.
So the first one, what's the hardest lesson you've learned in real estate so far?
Be very careful with your due diligence costs. A lot of deals seem really good. And so, as GP, we're kind of quick to put in the down payment and pay for the appraisals and the environmental studies and that sort of thing when we're doing developments, but you don't get that money back. So you gotta, just be, take the time. Due diligence is annoying and it sucks, but you got to do it because we've lost our due diligence costs in the past, and that's painful.
Well, yes, that's called your dead deal cost.
Yeah.
And it's all part of doing business. All right. So, what have you found to be the most effective way of building your active investor network so far?
Yeah, for me personally, it's been having a podcast and having guests on there. We talk about, in my situation, scaling healthcare organizations, but then we also get to have off-camera conversations about investing in real estate.
And so, what kind of guests do you have on that are?
The name of the podcast is helping healthcare scale, which we talked about raising money on there because some of them do raise money because when
Hmm,
you were a guest on the show, but the a lot of the guests are multi-site healthcare group executives. So we have had people who've had 700 locations,
my
CEOs of
God.
organizations with 700 locations, just come and kind of tell their story and share strategies.
Interesting. All right. So, what do you think makes for a successful capital allocator in today's environment, especially as you're about to embark on that mission yourself? What does it take to be successful?
Well, there's a lot, right? This is a loaded question, but I think first of all, you can't be desperate, which I'm sure you know a lot about that. It's just like if you're for me, I'm working on deals that are proprietary. I'm vetting these people, or we're originating our own healthcare deals, which nobody else has access to. So it's just understanding that I'm the only way that they can get access to these deals. If you want to invest in them, and there's only one of this deal, and there's a lot of different investors. So I think just like having a strong mindset of like, I don't need any one investor. I don't need to, bend over backwards or do whatever. Having confidence that this is a great deal and we're gonna raise the money with or without this one particular individual. Well, like whoever you're talking to at the time.
If you could go back to your first pre, while you were wakeboarding, before you started getting into investment, real estate, and give yourself some advice, what advice would you give yourself?
Well, okay, actually, when I first bought that house in 2011, there was a bunch of it was a crappy neighborhood. There was a bunch of houses on the street, like $30,000, and I thought about buying them up and I didn't. And I missed that opportunity. And I had no idea what a fund was. I had no idea how to raise money. I just thought, well, I don't have the money to do it. So I wish I could go back in time and tell myself, hey, figure it out. These houses are all worth, two, $300,000 now. Go like figure out a way to, if you have an idea or strong conviction, in particular, like these houses, figure out a way to get it done. Don't take the victim mentality. Raise money, partner with people, go execute.
Very nice. Yeah, that would be advice I would give myself
Oh, nice.
when I started a very long time ago. All right, last question. So, in terms of the capital allocation business, Austin, what are the biggest misconceptions you think there are in the market about that particular industry?
Well, I just think that people really underestimate what all goes into being a capital raiser. I think that you kind of have this thought, if you have a good deal, then they will come, right? Like if you build it, they will come. And maybe that's true for one or your first or second deal, but like if you really want to raise capital and you really want to, make an impact and make a difference, it's going to just take a lot of work. And then, like I talked about earlier, I only want to partner with people who have like 5 deals. Well, that's probably not realistically 5 years. It's probably 10 years, or 8 years. And so it takes a really long time of like showing up and putting in the work and having that delayed gratification and the people seeing like, oh yeah, this guy is not like a scammer. Like he's in it, he's authentic, he has integrity, and he actually has good judgment in doing what he says he's going to do. So yeah, it's not a side hustle. It's a full-time, vocation.
Austin, what's the name of your company? I know a lead, isn't it? Leader Real
Leaders.
Estate?
Yep, Leaders
Leaders
Real
with an
Estate.
S. Austin Hare, are you and you're a co-founder of that, or what's your role over
Yeah,
there?
managing partner.
Managing partner. Austin Hare, managing partner, Leaders Real Estate. Thank you for joining me on the podcast today.
My pleasure.
All right, that was Austin Hare of Leaders Real Estate. Austin, nice to see you again. It's nice to see you on LinkedIn all the time. And I really enjoyed our follow-up conversation. So let's keep that going. And if you can, definitely join me in the mastermind I will be running next month. You will find it extremely useful. Your questions are really interesting, and I would like to be able to answer all of them for you. All right, so that would be in the mastermind coming up. Anybody else that's interested in the mastermind, actually just email me. Actually, sign up to the newsletter. That's the best thing. Go to gowercrowd.com/subscribe or just hit the subscribe button. I will announce the dates for the next one, or if you are interested, you can just email me directly the first time you get one of those emails from me when you sign up and ask me, and I'll send you a link to join the wait list. Okay, thank you, Austin. Again, really a pleasure seeing you. I really enjoy our conversations. And thank you, dear viewer or viewers, hopefully there's more than one, for joining us today. I appreciate that. I hope you found my conversation with Austin as interesting as I did. But for this week, that's all I've got. Until next time, this is Adam Gower signing off.